Hey everyone, just a quick update here. Not really going to be talking about charts too much or trades, really, just kind of going over the month of April. First things first, the numbers came out. GDP below the forecast, pending home sales below the forecast. Yet the market absolutely boomed today. Have no fucking idea how it can just absolutely skyrocket when we're seeing these just unbelievable numbers, like negative 4.8, and it's absolutely booming. I don't know how that even works. Double the forecast of the pending home sales month over month for March. The previous was 2.3 positive. Forecast was deep in the negative, and it just absolutely doubled it, crippling, but obviously the market doesn't give a shit about it. We do have some FOMC statements and talking about rate cuts or the decision of the interest rates, so we'll see how that goes. But clearly the fundamentals are not playing a part of the technicals at all. And for this whole month, I was, in my opinion, too fundamental biased. That's a problem if you're combining fundamentals with technicals. It's good overall to couple them to some degree, in my opinion, but I got wrecked real fucking bad this month because I was too short biased. I was too bearish. I got stopped out on BTC a couple times. Absolutely fucking boomed up. If I was looking for that wedge. Took a few trades, did alright in March. Didn't come out too positive, but April really fucking wrecked me, to be completely honest. I managed my rest as well as I could, but I was just looking for too many shorts on here on BTC. Looking at this little downtrend, took a couple trades on it within this zone, got wrecked, and then once it just blew up to the upside, I didn't even touch it. I just didn't know what was happening. Looking for the miners to put a little bit more sell pressure on, but clearly they were not looking to short anything, really. They just let it go, kept BTC in the treasuries, and so that theoretically could be the minor capitulation. I don't exactly know, to be completely honest. I think I'd rather wait it out. If you don't know, when in doubt, get out. And I currently... after this huge move, I'm just not going to touch BTC for a little bit longer until I have a better understanding of what's happening. And that wouldn't be until at least a halving in May, because then that'll give me a little bit more of a catalyst to go off of. But right now, I'm just completely sitting on the sidelines doing absolutely fucking shit all. In basically all markets here, alts, haven't fucking touched them. Super confusing in my terms, in my view of what's happening. EOS was a bit of a good play. Didn't enter it because of my bias. Really just was not on a lot of moves here this month. Thinking about potentially not playing fundamentals into it as much. Yielded me pretty positive results before, but yeah, clearly April was too much fundamentally biased, and I wasn't looking at the technicals enough, and I wasn't playing into the actual TA of the price action of Bitcoin. So a little bit surprised on that end, to say the least. In terms of the equities, very much surprised at the significant bounce compared to how much shit news they've been coming out with in terms of the actual numbers. Not some bullshit Gilead news with treatment of people who already have COVID. It's not a fucking vaccine. It's just treating people who already are sick. And the market absolutely pumped on that news and completely disregarded the absolute decimation of their market expansion and the start of the contraction cycle of their bear market. And I just can't fucking believe it. I don't really have much else to say. I'm still not going to long. I'm still not long bias. I'm still not bullish on the stock market. I'm just not going to have any skin in the game until I have a better understanding of what's happening. But at this point in time, we got a new little trend line going on here, which is going to be this guy right here. That's going to be a possible situation, but I have very, very low confidence in a break and a continuation until we start to see actual momentum come down. We did get that pretty big gap down, which I was really confident about. And then once we saw that wick close right at that 50% level, leaving a wick to the top side where the supply zone is, and then a few candles closing, that looked pretty good in terms of the 4 hour. And then once we started to see that uptrend kind of move back above the 50% zone, I was surprised to say the least. And then once we started to move back up, I was a little bit worried, and yeah, recently hit my stop loss. So I was definitely a little bit surprised on that one. I'm not going to go long. I'm not going to look to make any investments in the equities market. I'm still short biased because of the fucked fundamentals of just the Fed, I guess, printing shit tons of money, creating stimulus, people in disbelief, huge decoupling from stocks and the actual economic situation and health of the world. But you know, the markets can remain solvent more than, or the markets can remain irrational more than you can remain insolvent. So I clearly learned that lesson in the markets for sure. I'm very surprised, but anyways, that is the market video for today. Not a huge update or anything. I'm not going to go on the charts or anything. I'm personally not going to be entering anything anytime soon. Got pretty wrecked for April for this month. Managed risk. You got to always manage risk. I knew how much I was losing on every single trade I was taking. It's not like I got caught short-sighted or anything involving mismanagement of a position or mismanage of risk, but yeah, let's just say I'm really fucking surprised, to say the least. But yeah, if anyone has any questions, that's fine. Not really going to be doing any crypto market update or global macro update. You know, I could talk about news, I could talk about all this stuff, but in terms of the trades, especially for Bitcoin, I was wrong, definitely. Thought there was going to be another low. Didn't think that it was going to surpass it, but looking on the weekly, you know, I thought that was going to be another touch of that zone here. Consolidation a little bit longer, and then once that halving came in, I thought it was going to be another little lull here, and then we were going to get, let's just draw it in. Thought that was going to hold kind of around here, because we saw a lot of wicks pushing the price back down, so I thought we were going to hold somewhere around maybe 7K, something around there. We clearly did not, and then what the situation was going to be was if we were able to see a nice low come in somewhere around here, and then that would be, in my opinion, a good area for a potential entry for a long, but just kept on going up here, and I was being patient, and I still am patient. That's fine and dandy, but yeah, it's definitely difficult trying to couple the fundamentals with the technicals. Technicals was looking bullish. I firmly agree with the fact that it was forming higher highs and higher lows. You saw some squeezes. Like, that was a really good squeeze right there. Once it broke that, I was very worried, but I didn't want to change my bias just yet. But that was the major break. We also had another little break right here with that little squeeze like this. So we got a couple of the breaks here where I guess you could draw in something like this as well. And let's get our snip. I'm just going over where I fucked up. Because yeah, I can honestly truly say I fucked up. That's not a problem. People make mistakes. I was bearish on this whole fucking move because of the miners putting pressure down, seeing this chart. I guess this chart represented a little bit better. You see that a lot of miners are in the red, are mining unprofitably. The difficulty adjustment has not kicked in yet. The hash rate has not dropped enough for it to be a major difficulty adjustment. So until that difficulty adjustment kicks in, meaning that there's a lot of people getting off the network, not stopping the mining process, the difficulty adjustment will not change. And I was waiting for that to come into play. Like we saw right here, There's difficulty adjustments when the miners were getting squeezed, meaning that the cost to mine one Bitcoin is around the same price as one Bitcoin. And my speculation was, because a lot of miners are in the red, when there is sell pressure coming in, it's going to exacerbate and going to create more aggression towards the downside. That's why I was more short biased. But yeah, it didn't seem like it came in here with the shorts. So the first short I did, let's take a picture right here. I think I did it before. The first short I did was this one right here, I believe. So then a push, pull back, push, massive push to the upside. That was the first little wedge. Did not break too favorably there. I think I broke even. I think I made some money here, and then I broke even here. So I made a little bit of money there. So that wasn't the worst of it. That was still in March, though. So March wasn't a bad month for me. It wasn't great, but it wasn't terrible. And then we got a little squeeze right here, as you can see, with the resistance and support. I was mainly looking at this horizontal zone of resistance at around $6,800. We saw a key level of resistance hold there. And I was looking for a potential break of some sort of ascending zone because we were creating a little squeeze. And then now we broke to the upside, created a new higher high. I actually entered a long within this zone right here. So once this little squeeze broke, I did enter a long. Rode it up here, came back down. When it started to look weak, I then took off my long, basically a break even, made like not a whole lot of money on that trade because I was more short bias. We knew that there was a supply zone there, and we were looking for short opportunities. I saw another trend line connect these highs like this with a wedge like this, and then once we started to see this kind of price action right there, especially with that big wick to the upside, absolutely getting wrecked right back down. Yeah, that to me was another short opportunity, which I did take a part of, and it did not play out. So it looked pretty good. Had two attempts to move to the downside, absolutely rejected. After that rejection, after that push off the resistance and above it, I basically gave up on shorts, and I said, look, I'm still short bias. I still think that I don't want to long just yet because of the fundamental factors with the mining, with the halving, with the correlation with the S&P. I just don't want to long just yet. I don't think it's ready for a move to an upside. So I drew this resistance in. Didn't take any trades on it for a short, but I'm basically looking at this descending zone and basically this level of support, and I was looking to see the price continue in that consolidation. Obviously, that didn't turn out to be something that occurred. We got our first little push to the upside. We got another little push. We formed a little wedge, and then we absolutely mooned here. So, to be completely honest, yep, I'm not going to be entering long or anything. Obviously, it's way too late for a long opportunity. I'm basically going to be just sticking to the longer term time frame, seeing what we're able to find. Talking about the weekly, I know that there is going to be a level of resistance coming up here around 10.1. We see that this previous resistance will act as some level of supply right around here, which will be in confluence with the descending zone for our major structure that we have for our weekly chart. But in terms of which way we're going, to be completely honest, in terms of the macro, I think we could hold this triangle for a little bit longer, but I'm not going to trade anything within this zone until I have a better understanding of what's happening, because I currently do not know what's happening. And it's, in my opinion, all right to not know what's happening. In terms of what we're seeing within the halving, I have a good speculation what could happen, and I have somewhat of a plan, but from now until then, I just don't really want to be looking for any opportunities to enter the market, because shorts are getting absolutely obliterated. Just you're stepping in front of a fucking massive behemoth of a train right now. if you're looking to short. And for longs, you're getting up to a point where you got some major supply zones. But I said that when we were at 78. I said that when we were at 7. But, who knows? We could just absolutely continue going up here. I have no idea if this is even a possibility to just keep on going up. I think there's going to have to be some level of consolidation with all the uncertainty in the market. But yeah, we'll see. A huge argument that the reason why Bitcoin's going up so much is the fact that it's a hedge against inflation. We're not even fucking getting inflation, everyone. We're not seeing inflation yet. Look at the economic stats here. This is, I guess, for future inflation, but right now we're not seeing any inflation. Yes, the Fed is printing a shit ton of money, but look at previous economic crashes. We don't get inflation until later when people start feeling better about it, and you start seeing velocity increase, the transactions starting to get higher. When you're in the midst of an economic recession or a depression, velocity absolutely drops, which reduces inflation and actually creates deflation. So right now, we're seeing deflation. So let's pull up another chart here and look at the... let me just look here. Monetary base. Yes, everyone's saying, holy shit, they're printing a lot of money. And yeah, they're printing a shit ton of money. I can't argue that. They completely are. And that is super bullish for Bitcoin in the long term. But in the short term, you're getting deflation due to the lack of velocity. And until COVID stops and you're seeing the velocity of money increase, you're not going to see inflation. Look how much deflation there is due to the decrease in velocity, and this is only going to go lower. The most recent one is Q4 2019. So Q2 of 2020 is going to be absolutely devastating for the velocity, which is going to be very deflationary. And also just in terms of the psychology of the masses, people are going to be saving. Are people going to be buying houses, cars, going on vacation, going to amusement parks after this whole thing? Hell no, they're going to be saving because they don't know when the next rainy day is. So in terms of fundamentals, I'm bearish. I don't think that inflation is a worry just yet. I think later on in life, when things settle down, there will be pretty big inflation, because then when velocity increases, the other piece of the formula for the actual true price of goods and services going up will come into play, which is velocity. But right now, we're just seeing the money supply increase, which is only a part of price increases. So we'll see how it goes. Pretty crazy, but yeah, I personally don't think that this scare of hyperinflation coming as an imminent threat is something to be worried about right now. I think later on in life, yes, it will be a worry. Yes, it will be something to fear, as debasement is something that is very serious and prevalent. But right now, I just can't see people spending shit tons of money and increasing the velocity of money and really getting that economic engine going again. It's just going against all the simple economic principles that I personally believe in. We can see over 26 fucking million people losing their jobs, and almost all companies are just devastated by this, other than a few select ones that are able to actually purchase their stock, like Amazon, like Zoom, like Netflix. Those types of companies, yeah, they have great cash flow. They can purchase back stock, but basically every oil refinery, every non-essential service, or any online e-commerce or digital service, they're getting absolutely wrecked, demolished. And the S&P is funneling basically their focus towards the companies like Microsoft, like Amazon, like Netflix that are doing well, and it's really pushing the index up, which is good for long-term holders. But for people who are trying to profit off of speculating that the economy is going to actually continue its descent and the stock market will inevitably marry back into the actual fundamentals and decouple from fantasy land, it's not good for us. But yeah, we'll see. I'll take some questions here. Hang in there. I absolutely got wrecked too. I appreciate your analysis, and I had the same belief. we'll be able to bounce back. Thanks for all you do and help educate us, Joshua. Yeah, appreciate your thoughts there. Yeah, April was not a good month for me. I can say that. Without a doubt. Bitcoin, not a good month for Bitcoin for me personally trading it, and got pretty wrecked on the SPX short. I managed my risk. I was able to definitely know how much I was losing beforehand. You got to be able to do that. You got to be able to cut your losses. It's not like I'm holding a short indefinitely. I have a trade plan. I have a setup. I have a structure. I know where I'm getting out, and I got out of my SPX because it went above the 61.8, and I could still be looking for a possible entry here later down the line for the SPX, but right now I just have no fucking hope that there's going to be an entry for me just yet until I start to see the momentum change. I'm just not looking to enter. The risk reward was very favorable in that if I take this trade every time, and if I have the same structure for it, and I'm just making sure I'm trying to get the best entries, the risk reward's favorable. I was looking at a risk reward of 5-1. So if I take this trade 3 times, and if I lose 2, and I still make money on the last one, I'm still in the profit. It's just very hard to, let's just say, accept the pain and suffering of taking a loss when you have high conviction. But I'm still not, in my opinion, going to accept this as a reversal like we did in 1987. Let's just quickly look at the Dow Jones in 1987 because we did get a flash crash and then a really quick recovery. So yeah, this is a current price action. Let's just go back and zoom all the way back out to 1987 because this is kind of what I'm worried for anything is we see something like 1987, which is right here. Flash crash. If you've seen Wolf of Wall Street, this is that movie where the start of the movie, he gets a job on some big bank broker. He loses it pretty quickly because of the 1987 crash. October, this is it right here, flash crash. And then, like always, we put our fib to candle closure. You could do the daily, whatever it is. I don't exactly know. We're looking at the weekly, but let's just do candle to candle. We see once the price passes the 618, it just continues its trend. And right now, the fundamentals are very different from what we saw in 87. But, like I said before, markets can remain irrational longer than a trader can remain insolvent. So, yeah, you can't hold on a short forever. Because if you held on a short in 87, you would be absolutely wrecked. So, yeah, I'm out of the market. I'm out of the short right now. I still don't want to call a reversal saying that this is long. I do not want to do that, but I'm currently being patient for this trade. Okay, VIX going to 40. Actually, let's look to see what the VX is doing. Yeah, 31. Holy shit, eh? That's crazy. And let's look at TVIX. Just another form of an instrument to measure volatility. It's like measuring volatility of volatility, I guess. 179. Wow. Yeah, so for massive spikes, TVIX, if you're super active in the markets, can absolutely boom. You're seeing like a slow consolidation in the 30s. And it went up to $1,000, 990. So, crazy 1,000% gains. It's a good instrument. VIX is good as well, but right now you're not really seeing any single pop. Like ideally, what you're looking for is these little pops here where you got big gaps, and then you're hopefully able to capture kind of the extension, the next extension. Obviously, you do have these little fake outs, but when you see these little pops, you're able to get a little bit more volatility coming in. And then it doesn't seem like a big move, but if you're actually catching some of these moves, they can go up to 20, 30, 40%. And then once you get the huge capitulation where the market actually falls, you're getting these 1,800% moves. So I'm not in TVX, I'm not in VIX yet, but it is a good instrument to use if you are looking to capture some unbelievable risk-reward situations, if you are able to identify a next leg down. See something like this. So It's an instrument that we could look at that I am keeping an eye on, I guess, on the back of my head. But in my personal viewpoint right now, I'm not really looking at it because we don't really see any weakening from the SPX right now. All right, this will take some time, but the fundamentals will set in and drunk market will get its hangover from Allen. Yeah, that's the expectation. Like since day one, really, of the call of the recession, like even since we were calling the inverted yield curve for basically a year now, almost like 7 months, we've been talking about the inverted yield curve inverting and talking about a potential recession coming into play within the next 365 days, and then just so happens in coincidence that COVID came in. Maybe speculate that it's not a coincidence if you like, but that was a little bit pretty perfect, and then we got that massive move to the downside, and now we're just looking for exactly like we had in 2001 and 2008. We got the same structure. Took an L. That happens. I'm still convinced, and I have conviction that this is not the bottom. How the fuck can this be the bottom? It just doesn't make sense to me. Look at all the economic news. It just... How the fuck can that be the bottom? It just doesn't make sense to me. And yeah, I took an L. I fully accepted that level of a loss. Still sucks, but when you're seeing these numbers of like unemployment claims and unemployment going to hit like 20% digits, it's just unbelievable that people are thinking that this is the bottom and that there's no more turbulent times to come for the market here. Like, look at some of these numbers. Total vehicle sales. Like, this is 2008 numbers. Look at 2000. This is nothing compared to what we're seeing right now. 17.1. Capitulation down to 11.5. That's 2008 numbers. So in my view, like, it's not just one industry. Look at cruise lines, look at airlines, look at bars, look at restaurants, look at supply chains providing services for those. Look at the entertainment industry, look at movies, look at there's a lot of industries that are getting affected by this. And yes, there are a few industries that are benefiting, but you can't just look at a few e-commerce and online streaming services and say this is what is making up the economy. It's not what's making up the economy. It just doesn't make sense. And I'm very, very open to waiting and being patient. I'm not going to put on more shorts of the SPY until I get more of a confirmation, but I'm not going to change my conviction. I'm not going to change the bias because of a little poke up through the 618 level. It can happen. I'm very open. If it does stick at that level and we just see a wick project out of that range, could be a potential opportunity, but right now I'm just not wanting to basically have a short on while this stimulus package, while this fake fairy tale perfect economy is still playing out. All right, let's go over some questions here. Trent is long on gold even if we don't have inflation right now, but just for a depression. Yeah, so gold's definitely not just an inflationary hedge, but it's also a safe haven. But definitely, I would say that if you are thinking that there's going to be an economic recession and this isn't the end of it, I do think gold's going to soar even more. Bit of a consolidation right now. Let's just zoom out to the daily chart. Yeah, it doesn't look bad, to be completely honest. We're in a bit of a tight consolidation right now. I think we could form this as a lower high. Oops. So then we could potentially be in a nice squeeze here for gold. Kind of like that. This is what I'm seeing. continuation pattern to the upside. This is, you could argue, a really shitty head and shoulders to some degree, where you got the left shoulder and the right shoulder in the head, and this is your breakout point at the $1,700 zone. You got a breakout above the $1,700 zone, and you're getting a squeeze series of lower highs and higher lows. Let's just take this out for a second, and this, and this, and this, and just making it look a little bit cleaner. Let's go here and get the projection out. Oops. Oops. There we go. Okay, so that's kind of what I see right now for gold. If you go to the smaller time frames, I'm sure we could draw in a smaller descending trend line there, but in terms of the larger time frames, I'd say that's a nice little squeeze that could potentially move to the upside if we start breaking the resistance, kind of like we saw. Not really there. I think there's not really a, I guess this kind of looks like it. Not really, but you can see the squeeze that we had here, where you saw, let's just get that green. You saw a big move up, you saw consolidation, and then you see another pretty strong push to the upside. Obviously different structure, but you see a push to the upside, you see a consolidation, which gold tends to do quite a bit, is it pushes, consolidates, and then pushes, consolidates. So pushes, consolidates, well, like every other chart, but gold definitely has these very, very tight constricting consolidations compared to a lot of the other assets that I trade. Crypto really doesn't do that nearly as much as gold. Gold really likes to contract in these tight ranges and then start pushing up when it does. But yeah, let's just finish off this. So for gold on the hour chart, this is basically the smaller time frame that we're going to be looking at. We see a larger squeeze of a symmetrical triangle, and then we see this nice little descending zone, not super well respected, but let's make it a little bit bigger. That's going to be your break to potentially get you to the resistance. So you could be playing within the symmetrical triangle, but like always, breakouts have a higher dependability than within triangles, especially when your risk reward isn't too favorable unless you are speculating that it's going to break the resistance. Like if you do get a nice little entry maybe right here, and if you are speculating that you just want to play within the zone, you're not really looking for a phenomenal risk reward. 2 is pretty decent, 2.2, 2.5 if you're really pushing it, but that's one option. Or if you just want to enter here and let it play out, and then if you do want to be looking for an entry when it does break, that would be your entry right around here if you want a little bit more confirmation. But that's what I see on gold. I'm being a little bit hesitant because we're just consolidating right now. And if we do break above this zone right around 1730, I think that would be a really good opportunity for me. I think I'm going to be a little bit hesitant on entering this zone. I think I'm going to stay clear of entering within this range, and I'd rather wait for a higher confirmation entry when it breaks that projection zone, personally. And then that could be a potential next target like 1800. You can see a larger squeeze coming into play here. So if we go like this, and then if it does push to the upside, that key level of supply at around 1800, probably going to have a little hesitation to move up. So I wouldn't be surprised if your trade was like something like that. We'll see how it goes, but maybe you want a little bit wider of a stop loss. But once you're able to get above that zone, I think you will have a lot more room for a higher risk reward situation, because you got the resistance there. Probably going to be a little bit more of an overperformance, a little bit more aggressive with maybe some wicks projecting up above. So I wouldn't be surprised if it hit the $1,800 zone, as well as just this major supply zone. Looking at the daily is a very, very important zone. If we look back at the chart, we see resistance get touched 1, 2, 3, right at around the $1,790, $1,800 zone. So it's a very key level for gold. I was going to say oil. For gold, so that's going to be quite possibly a good area to take profit, because my personal view, it does look like a pretty decent trade here, but yeah, going to be hesitant until it breaks that zone. So that's my analysis for gold. Going to get a little bit of water, and then I'll answer some more questions here. All right. Alan said, can you please also take a look at silver? I think it's about to take a big move to the upside soon. Okay. So just before we go on to silver, they're not exactly actually, we can see the correlation, I believe, within our correlations. I think there's gold and silver. Let me quickly check. No, there isn't. Let's see if there's a live silver and gold correlation. It's not just looking at the price action, but there's actually a mathematical calculation to see the correlation of two assets. It's called Pearson's coefficient of correlation, which is a mathematical equation that you use on a certain time frame, 90 days, 180 days, 365 days, to test how positively or negatively correlated they are. I don't exactly know the correlation, but let's just look at silver. Like always, let's go to the larger time frames before talking about the smaller time frames. Let's just take out some of these. So first thing I want to talk about is silver's major resistance level looking at the weekly chart. Gold, if we look at the weekly chart, had a series of higher lows and a horizontal resistance on the weekly, right? If we're looking at this huge consolidation, higher lows, horizontal resistance. Let's just go back to the 2 hour. But then on silver, it was actually the opposite, where you saw lower highs and a horizontal support. So in my opinion, silver was looking a little bit more bearish than gold, just because of the macro chart. But right now, we got a strong push up. We broke a key zone of resistance, which is around $13, $14. Let's just say right around there was our major level of resistance that we just broke below. So yes, I'm now looking for a potential move to the upside because we just broke right through that zone. If we take a look at the monthly, it's going to be a wick, which is a good thing. But on the weekly, I just wanted to make sure that we were able to close at this zone. So yeah, in terms of the weekly, monthly, it's looking a lot more bullish. I completely agree with you on that. Also looking at the weekly, we got a key zone at around 1660, 1650, right around there. So just something to keep in mind when we are looking for long opportunities. But then that's basically the key zones that we have. Next zone is going to be around $18. So that's going to be your major levels of supply and demand that we're going to be looking out for within the potential move to the upside. All right, now moving on to the daily chart, we're basically just going to be looking at this consolidation here, seeing what we're able to identify. Got a nice series of higher lows. We could potentially create a nice little move to the upside. We'll obviously make that a lot more cleaner when we do zoom into the smaller time frames. Oh, excuse me. Got a little move to the... Oh. My mouse is not really... Give me one moment. I just got to put the batteries back into my mouse. There we go. On the resistance side, not really. I don't really like that trend line. Let's move into the smaller time frames to see what we can find here. So, pretty happy with this trend line. Initial resistance turning into support multiple times. Definitely going to be putting in a nice projection at that zone. Got a nice series of higher lows, so I do agree with you that it does look a little bit more bullish. The major fact that we broke above the supply zone definitely indicates that there is buyers within the market. Let's just see if we can connect these zones like so initially. Okay, so let's just zoom out a little bit. Let's see what we could find here. So I do see this zone right here. Maybe we can move that just like so. not perfect, because initially the trend line was coming from here. That was the initial trend line, and once that broke out, that created a move to the upside, and now we're looking for a secondary resistance zone, which theoretically we're kind of looking at just this zone. Oh, come on. We're just looking at this zone, like here. But we want to see the previous price action to see how well is it validated, how dependable is this zone. And looking at the price action, we see support, 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 breakdown, resistance, resistance, and then now it's coming in and being used as a resistance again. So it looks like a pretty good squeeze. I think being a little bit patient and waiting for the market structure to change. We'll go into the smaller time frames. This is still the 6 hour, but in terms of the larger time frames, that definitely looks like a pretty good structure to be looking for a possible opportunity to the long side, because we made a massive move to the downside. We were able to break out of the structure lows. So this is a low, this is a lower low, connecting the lower lows. We saw a lower low right here that broke to the upside, shifting our potential bias, as well as our major structural support and resistance that we broke, which was this zone right around here, the 1450 range. That was that major weekly and monthly zone that we needed to pass. So because we passed this zone, it's looking a little bit more bullish now. And we know that previous resistance equals new level of support at that 1450 range. So the fact that we're now breaking above the zone, we're holding an ascending zone connecting a series of higher lows, and it's looking like we're making moves to the upside here like that with just a simple uptrend of a wave. It's looking pretty good. So let's now go to the smaller time frames. We've really dissected the larger time frames, kind of understand what's happening. We are in a squeeze, but it does look like we could be shifting to the upside. So now at the 2 hour, I think that's going to be the execution. 2 hour or 1 hour is fine with me, and I have to stick to the 6 or 4 for the larger move, why we are entering, and the 1 and 2 are just more for like the direct entries. So if you want to be a little bit more aggressive, entries holding this green zone kind of within this triangle would be an entry of a potential breakout, but the highest confirmation trade, in my opinion, is when you see the break of this key level of resistance that got rejected multiple times. We could, I think, bring it a little bit lower, just like so. And let's take a picture again. So this is that resistance that I want to see broken. So if we see a nice bullish engulfing candle like this, and the price closes above that zone with a 4 hour or a 2 hour, that would look really, really good. If we see the price close at that zone with a wick, I'm not interested. But in terms of where a good place to enter, in my opinion, would be is once we see the break of this horizontal zone at around 1550 would be the highest confirmation. Although having an entry at sub 1550 in the 15s wouldn't be a bad suggestion, as long as you're able to understand that you are in a less probable situation until you break this 1550 zone. And then once that breaks, you got 1650 as your major level of a first resistance, and then you got your 1850 up here as well. But obviously it's going to take a long time for you to get for the price to get there. For longs, if we enter right here, let's just move to that's 2 hours, fine. And then you could be looking for your first potential trade, something like this. So you get a risk reward of maybe 2 and a little bit, depending on how much further you're going to go above the 1640 or 1650-ish level of resistance. But that would be, in my opinion, the first zone that I'd like to see. So then let's just take our snip, and that's going to be the first take profit ideally that I'd like to be looking at, is see a push to the upside. Once you see that validation, looking for entries at that 15, let's say 38 zone, retesting the previous resistance shown here as a new level of support before you make your next impulse push to 1650. Once that gets hit, you don't exactly know what's going to happen. Kind of like we saw here, you could get a little bit of overperformance, and then you get your consolidation. So you could go a little bit higher to the 17s, but that's going to be my analysis for silver. I haven't been looking too closely at the commodities recently as much, just because A, they're in consolidation, and B, I thought BTC and SPX was going to do something different than what it did, but yeah, it looks like it's consolidating, kind of setting up for the next nice little move there. Ever since it kind of got up to the 17s, we were looking at this squeeze that occurred right here. But yeah, a little bit hesitant. I think the next move is going to be somewhere like we're going to see right here, and then which would mean that silver is going to be pretty bullish as well. So that's the overall view of silver. Don't really have much else to go. Can you please also take a look at silver? One thing to note is a gold and silver ratio, actually. Looking at the weekly chart here, zooming all the way out, we were in a massive wedge that absolutely blew through the roof, and now we are just consolidating at the highest point we've ever really been for the gold and silver ratio, where you can get 112 silver ounces for 1 ounce of gold, which is the highest it's been in centuries, really. So just looking at previous historic time frames, you can see that silver is very undervalued, but that does not mean that it can't go more undervalued. So this is the gold and silver ratio. The way I look at it right now is a potential head and shoulders if we hold the 111, which wouldn't be the best, because that means that, if this goes down significantly, that means that the value in the comparison of gold and silver is going down, meaning that silver is getting stronger, which could be a good thing. If gold stays still and silver has a strong move to the upside, this chart will break down to the downside, which wouldn't be a bad thing. Silver gold ratio can go back to 95, maybe retesting that major ascending wedge would be super good for silver if we do get gold to break down below this zone here. But if it does look like it's a head and shoulders and it's sticking at this zone, this 111 zone, and it goes back to 117, silver could remain stationary, gold could push up, or they could both go down and gold just goes less down than silver. So this is definitely something to keep an eye on if you are trading the commodities market, is just understanding the relationship of gold and silver. So we'll see where it goes. If this does push back up, wouldn't be the best for silver, but that could just mean that gold is going and appreciating higher than silver at that point in time. That doesn't mean that it's super bearish for silver, just means that gold could be more bullish, but just something to keep in mind. We are getting a nice little squeeze there. If it does push back up towards that side, it will be good for gold. So yeah, that's basically the commodities. Looking like it could set up for a good opportunity in the near future. I think it's a little bit too early right now, but it's definitely something that I'll be looking out for a possible opportunity, maybe at 1732, 1730, somewhere around there. Also, will be interesting to see how the economic calendar and the stats come into play. Jed said, markets can stay irrational longer than you can stay solvent. Yeah, I completely agree with that one. That's why being able to basically just say, I'm wrong, I don't know what's happening, I'm going to take off my trade, take the L, take the loss, and basically enter when I have more confidence. Not conviction, because I still have high conviction that the stock market will fall. It's just a matter of having the confidence of when to enter. And right now, I don't have that edge, so I'm just not going to enter. So I do completely agree with you. But in terms of, the permeables saying, always buy the dip, the Fed can always save us. I don't believe in that either. I don't believe in that at all, actually. Because taking a look at Japan, yes, the Fed, the central banks of the United States, has gone a lot more aggressive with how they're implementing QE by literally buying junk bonds and anything that has any value or even doesn't have value for junk bonds. Like, it's not capitalism. Just to put it straight up, the United States is not a capitalistic country anymore because they don't have free markets. If there's junk bonds, if there's shit companies that have terrible management that can't save for a rainy day, if they are unable to make payments because they have shit managers and executives who can't save for a rainy day, well, that's not a problem. They're not going to go bankrupt. They're not going to lose their jobs. They just get a bailout from the Fed. That's not a problem. So basically, America is not a free market anymore with the Fed being able to buy junk fucking bonds. Like, not even their own treasury bonds, but junk bonds from corporations that are mismanaged, that have executives that can't save for a rainy day. Like, the airlines literally called for a bailout 2 weeks into closing operations. That's terrible. But they'll get it. They'll get the bailout because Fed can't have any bankruptcies. Looks too bad. A little bit shitty, but to be completely honest, this could be a different market to trade altogether, to be completely honest, because like for the markets, the way I look at it is, it's not impossible for the Fed to, I guess you could say, save the stock market. But it's not saving the stock market. When you look at the comparison between equities and the US dollar, that's what you're seeing on a chart. It's not just the price of the S&P 500. It is the comparison of the value of the S&P 500 to the value of the US dollar. It's not just one thing moving. It's two things, like the Forex market. Like cryptocurrencies, if you're comparing Bitcoin to Ethereum. There's two different assets that are moving. So when you're looking at the comparison of the S&P 500 to the US dollar, if the S&P 500 remains absolutely stationary and the value of the US dollar drops, this is going to go higher. You could have zero change in the value of a company. You could have zero value in the progression, in the production, in the efficiency of a company. None of that needs to change. The revenues can stay exactly the same. They can actually decrease. But as long as the value of the US dollar is going to go down, you can see price appreciations, or what looks like price appreciations with the stock market. So this is kind of what I'm worried about, is normally if you don't have Fed print unlimited money, unlimited quantitative easing to basically stop a stock market crash, this would crash. It would. Look at the economy. Look at the stats. How the fuck in the world can it be a 30% drop when we have these numbers that look like this? When there's 30 million people that are out of a job in less than 6 weeks. In a month and a half. That's unprecedented. But look at how broken this chart is. How is that not the most bearish thing you've ever seen in your life? Now, just because of that stat and because of other things, just look around. It's super bearish. But what the Fed could do is print enough money that it devalues the dollar so fucking much that the stock market doesn't look like it's going down. Because the value of the dollar is plummeting to on a cliff. They could do that. So I don't know what's going to happen, to be completely honest. Either way, it's really bad. If they're going to devalue the dollar and basically destroy the dollar to save financial markets, you're not saving the economy. You're not doing shit for the economy if you are going to debase the currency. You're actually making it worse for the people living in your nation if you're going to debase your currency. But what you're doing is you're saving the rich 0.1% investments in the fucking stock market, in the asset prices. It's bullshit. It's absolute bullshit. But this is the world we live in. So now we have two options. We have basically, the Fed can't save us. I did a video on this. The Fed can't save us, and we can basically assume that the stock market will go down. Deflation will come into play. Reality will kick in, and you're going to start to see the stock market go down. We'll be doing pretty well. We'll be making good money if our bias is correct. That's fine. That's great for us. Shitty for the economy. Excuse me. Option 2. The Fed prints so much fucking money and puts so much stimulus in the market that they create enough aggregate demand to keep this afloat, keep this fucking fantasy afloat, which then they will have, 100% of 100% of GDP is by the government. Like, how messed up is that? Japan has, I forget what percentage, but Japan has more aggregate demand in terms of stimulus than actual economic output. Let's just look here. Japan's GDP. Okay. This is it right here. Let's see if I can get it really quickly. So this is talking about Japan, looking at what happened with Fed or central banks trying to basically stimulate themselves out of a recession. This is what they tried to do in Japan, right? Japan was effectively in a bubble economy propped by cheap paper. That sounds exactly like the United States. Japan turned to Keynesian remedies, so Keynesian economics, which is basically printing money, lowering interest rates, and increasing the government deficit. This is Japan's response to the 1980s asset bubble, when it bursts in the early 90s and it lasted an entire decade. The deflation lasted an entire decade. But yes, the Fed acted a lot quicker. They acted a lot more aggressively, but we can see series between 91 and 1995, they left the discount rate at 0.5, just above zero bound. Fiscal policy was aggressive during the 1990s when Japan adopted 9 stimulus packages during the decade, totaling 140 trillion yen, or equivalent of $1.3 trillion. These measures were unprecedented for a modern industrial power like Japan, yet there was still no recovery. Interest rate manipulation and mounting huge fiscal deficits have not helped Japan's economy for nearly 30 years. The effectiveness of Keynesian remedies employed should eventually be called into question. Otherwise, the United States and Europe seem doomed to follow Japan's footsteps. This is, in my opinion, an example of using unlimited money printing, unlimited QE, modern monetary theory to try to solve a problem. They already tried to fix this in Japan by creating unlimited stimulus, and it didn't work. So, in my view, it's happened before. Yes, there were some differences in monetary policy to some degree. A lot of people think a couple of the reasons why Japan fell. First thing, America has the same problem as Japan in this sector: demographics. Japan has a 10-year, on average, older demographic age as a median age within the nation than America. So I think it's like 40-something or something. Let's just look. Actually, I'm not going to look. It's around 40-something for Japan and 30-something for America. I don't exactly know. But Japan, in terms of the demographics, the median age for an individual in each country, Japan's 10 years ahead. So their demographic, their largest demographic is 10 years ahead of us-ish on average. So we can look at them and see how the demographics impacted the economy when going through it. So when you have a huge demographic coming into an economy, initially when they're getting introduced, it's extremely inflationary. Because everyone's buying their first car, their first clothing, their first couch, their first house, their first paintings, their first shoe, everything, right? If you're a young individual, you're going to buy a bunch of new stuff. And then when you're growing, increasing your income, you're going to buy more stuff, and more expensive stuff, and bigger stuff, and better stuff. It's inflationary. But as you retire, you're not going to buy as much new stuff because you don't know how long you're going to live. You're going to stop working and you're going to need to live off interest. You don't know how long you're going to live, especially with modern healthcare. People live up to 100. You don't know. So when you're in that mindset of, okay, I need to save because I don't know how long I'm going to live on, and I need to live on interest, you're going to start being more of a saver, of a deflationary mindset. You're not going to go out and be a major consumer. It makes sense. And if you want to go on your vacations, if you want to go out and buy that new car, you might need to sell some of your assets, sell some of your equity in order to pay for that. and you're pretty much a sell side only individual. You're putting pressure on the sell side, not much on the demand side. So it's very deflationary on the way out for a large demographic. Right now, America's baby boomers are retiring, so they're in that same cycle. That's one thing that Japan and America have in common. Another thing, Japan was more aggressive when they started to have that blow up. So let's actually look right here. This is Japan during that massive asset bubble collapse. 1990 was the peak. 1991 and onward was like the major fall, and then we had the last decade. But basically, this is the peak of the Japanese stock market at the height of the asset bubble, right? So what did they do? We already talked about demographics. The second thing they did is they talked about the interest rates that rose to kind of start this collapse. America didn't really have that, but then we did have massively skewed interest rates to the downside. We had artificially low interest rates at the start of 2009 for 7 years, all the way into 2015, I believe, when we started to raise interest rates. When we started to raise interest rates to up to 2.5%, we started seeing major sell-offs within the stock market. 2018 was a rough year. At the end of 2018, we had massive sell-offs, and that's when we started to see the worry of increasing interest rates. So there are some similarities in that regard. A lot of people say that savers were a fault for Japanese deflation. I don't really think that you should blame people for trying to save because of the economic downturn that they have. What's his name? Krugman, I think. Economic, what's his name? Something Krugman. What's his name? Paul Krugman. Yeah, he is a major hater on savers. He fucking hates savers, and he thinks that everyone should be a mass consumer. And yes, that keeps economic gears turning, but to say that everyone should be in debt and everyone should spend their whole income, I don't think is the right thing. But yeah, that's for a different topic. But we'll see. Wow, a lot of people commenting here. Didn't really look at that. So let's go to the comments. Paul, just one thing I wanted to share. Currently, all job claims are temporary, not like other recessions. After lockdown, a lot of them will get jobs back, but I agree with Fed is doing disgusting. I might be wrong with just how it seems. Yes and no. Let's look at another unemployment claim. Unemployment claim. There it is. Give me one moment here. Extended. Fred. Continuous claims. This is it right here. This is the chart we're looking for. Okay, so your question is talking about the fact that this is temporary. Not like other recessions. After lockdown, a lot of them will get back to work. Okay, so this is the initial claims. We've already seen this chart absolutely broken. This is just the new people going into unemployment, right? So we can see, zooming in really close, this is 211,000 brand new people who are now unemployed. This is now 282,000 brand new people. Right? We have 3.3 million brand new people. It's like not really letting me. And then we have another 6.8 brand new, 6.1 brand new, 5.2 brand new. And if you add all these up, right? Like 3.3, 6.8, 6.6, 5.2, 4.4. This is each week. This is brand new. This is continued claims, right? So the discussion is these people will get their jobs back. Okay, well, for one, they're not going to get their jobs back unless the economic goes into complete reopening where social distancing is not getting affected. You're going to have airlines, cruise ships, restaurants, bars, movies, entertainment services. They're going to have to all be open to the same level. Now, let's say they do that, right? There's two things that, for me, is a worry. First thing is second and third waves. We've seen countries that are far more aggressive within their attempts to curb the spread, like Singapore is very, very aggressive. Thailand is very, very aggressive. China is very, very aggressive in their means to try to handle it. And they're getting second waves. They're getting third waves. And I don't think America will just be a one and done, especially because there's the protests against COVID and people are going into large groups. There's not really that much consideration. There's going to be more and more waves. Two, you're seeing the psychological damage that this has to the economy. You're seeing in China, the restaurant industry, the sector, it's not seeing a big bounce up. People are not going and spending money and going to restaurants like they used to. They're not going to enjoy a nice vacation. It's still very much in worried, fearful states right now. And in my opinion, it's not going to be an instant bounce back. I know it's a speculation, but continued claims, like this is continued on unemployment claims, and it's still skyrocketing. There's no end in sight. There's no one getting employed back again. No one's getting off of EI, employment insurance or unemployment insurance. It's still increasing. So until we start to see the continuous claims slow down, where people are getting off of EI, off of unemployment insurance, and back into the workforce, you're not going to see the economy, the true actual health of the economy, start to go up again. Because people in jobs is a vital key of economics. Obviously, people need fucking money to spend money. If people are just basically getting handed money by the government, freshly printed, that's not a great economy. If the large majority of people in the economy are just getting handouts from the government, that's not healthy. There's no output there. There's no productivity for services, products, innovation, entrepreneurialism, building new businesses that is going to create more prosperous futures for humanity. There's none of that. It's just sucking on the fucking tit of the government and saying, hey, they can help us out. Like, yeah, like if you lose your job, you need that and it's a difficult time. I totally understand that. But just saying I can't do anything about it, the government will help us in every single situation, and the government is almighty, I don't think is the right way to go about things. And until we start to see the continued claims decrease and you start to see less people actually receive money from the government, you're not going to see any changes. And yes, you're seeing the number of people on a weekly basis go lower, but that's just because the worst is over. Like the people who are already going to get laid off are already laid off. Now it's just the people that don't need to be laid off, but now companies are really, really skimming the surface. They're barely profitable, and they're firing people who are, I guess, not necessarily needing to get fired, but the companies are just not generating enough money. And some companies are hiring a shit ton of people. Amazon, Zoom, Netflix, yeah, they're hiring a shit ton of people. Other e-commerce or streaming services, yeah, they're hiring a lot of people, but a large bulk of the companies are firing people. They're not hiring, they're firing. All right. Getting a little bit of water, and let's continue on here. All right. So Paul says, if business is not to file bankruptcy, I agree. They not gonna hire all at the same time like they fired, but still people will start flying again, use hotels, eat out, etc. Yeah, I completely agree with that. It's very predicated on when the lockdown will end, in my personal view, which obviously that is exactly the variable that's needed to change in order for those industries to start back up. But you do have to take into account the psychological damage that this will have. But yeah, we will see. I do agree that The world is not ending. There will be a time when airplanes will fly in the sky, hold a shit ton of people because they're going on business meetings, they're going on vacations, they're going to see family, they're going to do all this stuff. That'll happen for sure. I just don't think it's going to happen as soon as people think, in my personal belief. Also, I think you or someone else mentioned that file claim unemployment, you have meet some kind of criteria to claim, like freelancers, etc., so they claim probably much bigger. Yeah, exactly. I completely agree with that. Freelancers, let's say you're, for example, I don't know, a musician playing at a local club, or a DJ playing at a local club, or whatever it is. You're not in this, right? Because you are a freelancer. You don't get unemployment insurance. You don't have an employer saying, oh, well, because we can't hire you, can apply for unemployment insurance. These are the people that are going to be getting, I think, the $1,200 check and the $2,000 check for Canada. I think that they are sending out. But yeah, I do agree with you, Paul, that the number is going to get much bigger. And what is going to be a big number that's going to come out is going to be the unemployment level, which we can see right here. March was not too bad, but April is going to be a huge number here. This is on a monthly basis, so it's going to come basically in a week here. I don't exactly know what day it's going to get put out on April, but I will be looking at this every single day to see when it comes out. Actually, we can look at that. We can look at the economic calendar for that, actually, because that will show us when those numbers will come out. Let's just put the filters in just for America, so I can clear out all of it. Just go to America, and then we'll see when the major job numbers will come into play. And then let's just do the most impactful news. Oh, filter, come on. Most impactful news, okay. And then I believe it's next week, because today we had GDP. Let's just look at it here. Today we had GDP, we had home sales, absolutely disgusting, but clearly the market doesn't give a single fuck about anything involving the actual health of the economy. They just care about fucking speculating. So that's interesting to trade. FOMC. Actually, they're probably doing that right now. Interest rates have not changed. So actually, I want to take a look at that when I complete this live because I want to know what they said. But Fed interest rate decisions have not changed. They're sticking it to 0.25%. And we'll see how that goes. Let's look at this week. Initial jobless claims on Thursday. That really hasn't impacted the market too much because we've seen some crazy jobless claims, but obviously they haven't impacted the market at all. It's an absolutely fucking nothing, which how the fuck does it make sense? I don't know, but we'll continue on. The PMI numbers will be coming out on Friday. Those are some pretty important numbers to go over. And then also next week is going to be the non-farm payroll, NFP, and also the unemployment rate. So that's going to be on the Friday, May 8th. So now we have a number of when we will get this big, huge spike, probably inevitably. We don't know how much it's going to be, but we will see. So that's going to be the video. Let's just quickly look at some questions here. For sure, not instant. Yeah, I completely agree, Paul. Thanks for your thoughts. It's an interesting time. It's very an interesting time because the overall economic health is starting to show that is very, very negative. Even before, like you had major repo operations when the SPX was hitting all-time highs, and also the fact that just more of a global scale, people were already in negative interest rates. Switzerland, Sweden, Denmark, Germany, Japan were all in negative interest rates, abolishing all the savers' work and discipline that they've put in to save all the money that they've put aside is getting destroyed by negative interest rates as long as they're keeping it within a bank. So yeah, not good. Before this whole catastrophe, and now, in my opinion, it's very bearish, and I'm still going to have that bias. I do not think that the market is going to correct and hit an all-time high. I'm still going to have my bias that it's going to go down. Nicholas Gate, I believe is how you say your name. Hey, I'm new to your channel and new to trading. How do I get started? Is it right now a good time? Well, thank you for coming to our channel. We appreciate you joining in on our YouTube live. Welcome to the trading journey. How do I get started? In my opinion, it really differs on what your goal is as a trader. So if you are a person who has a full-time job, I guess this goes for anything. If you have a person who has a full-time job who doesn't really want to trade for a living and would like to create some side income, create more of a financially literate mentality so you have an understanding of what's happening within the financial world. Where to start? I would say just trying to understand money, where it came from, what it is a good way to start, and then going into more of like the fundamental monetary fiscal policies that are happening right now, like in terms of what does a federal bank do? What is the role of a central bank? Why is a central bank different from a government? What can governments do? What can central banks do? Because that obviously plays a major role in what we're talking about right now. Yeah, with what's happening right now, there's a lot going on, so it's hard to kind of break it down into like bite-sized pieces of what to talk about. But in terms of like what to tackle, there's like the global macro government / central bank side, and understanding money, understanding interest rates, fiscal policy, understanding stimulus packages, understanding quantitative easing. That is like a whole section within itself. And then see what happened in the past. That's a whole rabbit hole to go down to, because there's lots of times where people have debased currencies, and look what happened to the end result of the economy. You can see all the way from Rome, they debased their currency. Germany, with the Weimar Republic, debased their currency. Look back at major historic economic collapses due to currencies, and then you can see the relationship that the United States currently has with a lot of those. And then another thing is like just investing. Like if you're wanting to invest in stock markets, obviously, very different mindset that you have to go into in terms of understanding balance sheets, profits, looking at a lot of different indicators or stats like earnings per share, and understanding how to read a balance sheet, and understanding if you want to look at more dividend investments, more high growth, more blue chips. There's a whole thing for actual long-term investing. Dollar cost averaging is a great way to do it. And then there is more of a speculative, shorter-term trading mindset where you don't care which way the price goes, up or down. You're trying to capture high probability situations in the market using mainly technical analysis to identify your entry and exits. So yeah, there's a lot of different ways to go about doing it. I really find interest in trading in a swing trading type of situation where I'm holding for, let's say, a month, a week, a little bit shorter, but I used to day trade cryptos, kind of steered out of that and trying to get into the more global macro sense, which I really enjoy, but it's obviously a lot more challenging. You're competing with people that are pouring millions and millions of dollars in a year to be better than me, so it's definitely, that's the way you got to look at it. It's not a fun hobby. Like, trading is not a fun little hobby that you can do on the side that, you know, like, go take up sports betting or something, or like, I don't know, poker, if you want to have that sort of fun. But if you're actually looking to do this for a career, for a job, it's, to be super blunt, super high stress, super challenging. You will face failure with every single corner that you will face. It's an uphill battle with oil on the fucking mountain, so it's really hard to get up. And you will face depression. You will face a lot of sadness at the start. It's not easy. It's really challenging. But there's a lot of positives that go through it as well. Like, I think a lot of people are, especially on like Instagram and stuff, a lot of people show the flash of like, holy shit, you get to make your own time. You get to have your day to yourself every day. Like, I could go biking whenever I want. Like, biking is a huge, I'm a huge mountain biker. I absolutely love it. But I can do it whenever I want, which is great. But on the downside, yeah, like I lost a decent amount of money in April, and I'm suffering the psychological consequences of it. And especially when you're starting out, if you take it seriously, you will most likely be depressed in one time or another. To be completely honest with you, losing money is not fun. Getting punched in the face in terms of your ego is not fun. And it takes a lot of pain and suffering to get over the psychological skills needed to actually become a trader, which would mean that you are completely disconnected from your trade. You do not look at a trade as in having an edge in a single trade. You have to look at having an edge over a series of trades and a sample size. So it's very different in terms of how your brain has to approach losing or a trade. It's not one trade, it's a win or loss, and my entire ego is based upon it. It's, okay, if I take this trade 20 times, will I make money? And then you just have to have the confidence to take that trade if it is still showing that it's an A-plus setup. Next 6 months to a year is going to be really interesting. I completely agree, Paul. Nick says, is right now a good time to invest in cryptocurrencies? In my personal belief, if you're looking to long term, I do believe that this is a really good time to dollar cost average. I do think that there is going to be a bit of a drop for BTC. That's what I've been speculating. But in terms of where we currently are in the kind of monetary collapse that we're facing, or more of a fiscal currency collapse that we could be facing in our lifetimes here, I do think that cryptocurrencies is a great investment for the long term. It's a hedge against so many things. Inflation, it's a hedge against not just the United States dollar, but it's all currencies around the whole fucking world. It's not just the United States that are printing a lot. Look at the ECB, the European Bank. Look at Bank of Japan. Look at China. Look at Australia. Look at New Zealand. Look at Canada. Look at Russia. All these countries are printing so much money. And really, the only anti-fiat asset that people are going to be leaning towards when there is debasement of a native currency is going to be, in my personal opinion, precious metals as well as cryptocurrencies. Those are going to be the two main assets that investors are going to be looking into to try to hedge against inflation, hedge against the debasement of their native currency. We saw in Venezuela, the highest transactional volume was not 2017 at the peak of the Bitcoin bull run when Bitcoin hit just under $20,000. That was the top amount of volume that's taken place in almost every major country. United States, Japan, UK, Canada, Australia, all these major countries. Their peak trading volume was in 2017, started 2018, at the peak of the bull run. But in Venezuela, the peak of the transactional volume was 2017 was a blip. You can't even see it compared to what you saw in 2018, 2019 when the hyperinflation was really setting in. Let's take a look at that right now. Crypto links, BTC transactions by country. Oh, that didn't really work. Let's try that again. Perfect. Okay. So we see Australia, boom. Argentina. Let's look at this. Current. I'm just going to see what happened with unofficial exchange rate slumps. Yeah. Wow. Argentina's local currency's debt is also rated in restricted default. Holy shit, I didn't even know about this. I just opened this up. And then I saw the weekly Bitcoin volume in Argentina. Holy shit. Look at this. How do I close this? Get out of here. Fuck. Where's the exit? Damn it. Whatever. Okay, Argentina can't pay bills. A hard default is coming. Sorry, century bond holders. It was good while it lasted. Wow. Wow, that's scary. Everything done about Argentina's core business, from commodities trade to wine country to Patagonia tourism to its entire real estate market, is done in dollars. No one wants the peso. The poor have it. They can't afford dollars, and the economy is going nowhere. They're increasingly depending on the government for food. Meanwhile, the central bank is burning through reserves as it may be holy shit, and has maybe $12 billion to its name. Worth noting, failed state Venezuela defaulted its sovereign and PDVSA old bonds and once hit $10 billion in cash reserves. Holy shit. Yeah, so there's a big worry here in Argentina. And this is a perfect example. When there is a currency default, when there's a currency debasement, when there is worry about the native currency and the confidence is lost in a native currency, what do you see, right? Here in 2017, Australia, Canada, Brazil, 2017 was the peak for major countries. But in countries that you see a devaluation, a debasement of the currency, like Argentina, you see a huge spike because more and more people are using cryptocurrencies, Bitcoin, to transact value instead of their native currency. So let's go here. Let's just go on. Nope, not here. I'm just going to go not B. Venezuela. Look at this shit. Okay? United Kingdom, USA. These major first world countries that don't have any real currency worry, their peak by far was in 2017. This was 2017, 2018, right here at the peak. USA, same thing, right? And you've seen a descent since then. Same as basically every other first world country. Venezuela, their hyperinflation is forcing them to either use another currency like the US dollar or cryptocurrencies. So the fact that we're seeing so many people flood into cryptocurrencies in countries that have major currency collapses is a very positive thing for crypto. Oh, excuse me. Wow, I didn't know about Argentina. That is crazy. All right. So yeah, that's basically Turkey, Thailand. Holy shit. Yeah, you see all of these countries. The peak is 2017, really. Romania, Poland, Peru's actually a little bit later. Philippines, Norway, Nigeria. Morocco, oh wow, they might have some issues as well. New Zealand, Mexico, the peso, wow. Yeah, but it's interesting stuff. It's definitely interesting stuff. And I think some people are actually using crypto to turn to the US dollar. Like you see stable coins like US Tether and other stable coins, USDC, which is Coinbase's stable coin. They're tethered, which is the word, or pegged to the US dollar. So let's say you're living in Venezuela, or let's say you're living in a very poor third world country. It may be very hard for you to get that transaction of your native currency, the United States dollar. You might have some currency exchanges that cost a lot of money, or they might not do small exchanges. They might have to have a minimum of some sort. If you're able to use cryptocurrencies, you can purchase Bitcoin and then purchase Tether or any other stable coin, and now you're pegged with the US dollar. So not even using Bitcoin, but using blockchain and cryptocurrencies is able to provide significant stability for individuals living in economic crises where the native currency is debasing or basically getting, devalued in some shape, way, or form. So, yeah, that's basically the video. I didn't want to make it too long, but it kind of turned into a ramble for an hour and a half, which is quite long of a video, but yeah, Good thing that people ask questions. I'm really happy about people coming into the chat. I really appreciate it. I just wanted to have a bit of a ramble because I know that yeah, I've been having my fucking bias for a while, and it has not come into fruition yet. I am still being patient on it. I got a little bit wrecked in April. I was able to manage risk on every single trade, but yeah, my bias was not correct. Let's just say that. And you know, as a trader who posts their stuff on public channels, I have to be willing to accept my losses, and I have to be willing to take full responsibility for the trades that I took and the trades that I didn't take. If you have a system, you should be trading that system. Even if you're not feeling good, you should be trading that system. I didn't trade my system because my bias was in the way. So yeah, I'll take that full responsibility. I'll take that loss. I do not fear rejection, embarrassment, because at the end of the day, you got to learn from it. If you're not failing, you're not getting better, you're not learning. And yeah, that was definitely a little bit of a failure, not being able to take any major longs for BTC towards the upside. Bit of a disappointment on my side, but on my side, but yeah, what are you going to do with the past? You can't really do much other than just patiently wait for the next opportunity and really understand where you fucked up, because yeah, I've been looking at longs for a while. Even this one, like, fuck, just my bias was in the way. Basically, I was looking at the market too close in just my fundamental view of, okay, there's minors, okay, it's correlated, okay, it shouldn't go up. There's a lot of things I was looking at, but there was just so many setups that I thought were good that I didn't fucking take because of my bias. Like this really nice resistance tune to support right here. Resistance, turn, support. Like, there's just, looking back, obviously you can see all the good setups, and you can't look at them and say I would have traded this, because sometimes you wouldn't have, and that's why backtesting is good using the replay button. But yeah, overall, I can say that this trade was a failure. It did not succeed. I did lose money, and as a trader, you have to accept that. You can't be complacent and never take off trades and assume that you're always going to be right all the time. I was wrong on the SPX short and the BTC. I'll still be waiting, but yeah, I have to accept that, and I can't really blame that on anyone else, really. You can't as a trader. As a trader, you have to take 100% responsibility. It is no one else's fault except mine. I take 100% responsibility of it. And that's how you got to live. Not the most fun all the time. It's sometimes really nice if you're an employee just to say my boss is shitty, and that's the end of it. It's really easy to blame it on the market, blame it on the fundamentals, blame it on the Fed, blame it on anything. But yeah, that's not how my life works. That's not how a trader's life works. You got to take full responsibility. Say, I fucked up really fucking bad on this one. And yeah, that's basically what you can do. Learn from your mistakes and move on. Make sure that you're able to manage your risk well. Like this month, I was able to manage risk, even though it was a pretty not so fun month to withstand. I was every single trade I took, I knew how much I was losing. That's the main thing. And at the end of the month, I knew if I were to take consecutive trades, I eased down, I lowered the amount of trades I took. So at the end of the day, you know, it's totally doable, but it's never fun being a trader and losing money on a month. But yeah, that's how you got to live. Hopefully, some people I give some perspective as to the other side of being a trader, of the negative side of being psychologically defeated, which is not fun. But yeah, bounce back, get back into it. Have a new mindset, and have a new month, and bounce back stronger than ever. That's basically the outcome that we're going to have. So yeah, hopefully you enjoyed it. Hopefully you got some value out of it. If you found it entertaining, if you found it enjoyable hearing someone get upset about their losing, hey, that's fine too. I don't really mind. Everyone has their reasons of wanting to trade or wanting to consume some sort of content. So we appreciate you watching. I don't really see any more comments coming in, but there's a decent amount of people watching. So we really appreciate all of the people watching. Trying to provide good value, good point of view, but at the end of the day, we are not financial advisors. We are independent retail traders that are just providing our reasons, our 2 cents about the market. You know, we're not telling you to do anything. We're just saying what we think is going down, basically. And we're not always right, obviously, with what we've seen in the market. Trading is definitely a game where you have to accept failure and you have to almost welcome it to learn. Like Ray Dalio says, if you don't know who Ray Dalio is, definitely I suggest recommending reading his book Principles. Great book. I'll probably read it quite a bit recently now. But he says pain plus reflection equals progress. So you're only going to progress when you feel immense amount of pain, you feel the struggle, you feel the defeat, you feel your ego getting fucking ripped out of you, and then you reflect on it, and then you say, hey, where did I fuck up here? And that's the most critical part about it, is not just saying you lost and go, oh well, but really breaking it down. Why were, and actually these are great because I can look back at the previous YouTube videos and see exactly what I was thinking on basically a daily basis. And it's kind of why I make these YouTube videos as well. I can see what I'm thinking. And yeah, that's what I'll be doing basically this upcoming weekend here. Is just going over the YouTube videos, going over my thought process, going over the TA during that time and telling myself, you're a fucking idiot. And sometimes you have to. I do it more times than I'd like to, be completely honest. But yeah, sometimes you just gotta look at yourself in the mirror and say, you are a fucking idiot at that time and you better learn from this or else you're gonna do that again. Yeah, sometimes people might say it's not super nice to say negative things about yourself, but that's the way I learn. You gotta be nice to yourself, but you also gotta be your own boss. And when you fuck up, you gotta tell that fucking employee you fucked up. And you gotta learn some way. And, you know, being Mr. Nice Guy all the time to yourself, in my opinion, will not really push you. Because if you're just always saying only good things to yourself and saying, oh, that's okay, you're just not going to improve. But, yeah, to myself, basically. But, yeah, you sometimes got to be a hard ass to yourself. And not fun, but it's necessary. So thank you very much for your time. Thank you very much for watching. I really hope you have a terrific rest of the week. It is Wednesday, so Thursday and Friday, we got some economic news coming in, but I don't really have any positions on the SPX. I'm still just looking, spectating on Bitcoin. Definitely a little late for some of these pumps here. Link actually hasn't pumped yet, but yeah, I think it's a little late on Link. But we'll see. Thank you very much for watching. I'm going to close off the video now. So until next time, have a good one.